Today, we're breaking down CPER, the United States Copper Index Fund, one of the most direct ways investors can gain exposure to copper prices through an exchange-traded product. If you're bullish on copper because of electrification, infrastructure spending, or global industrial demand, CPER is an ETF that's often mentioned first, but it's important to understand exactly how it works before using it. CPER does not invest in copper mining stocks, and it does not hold physical copper. Instead, CPER tracks a rules-based index of copper futures contracts traded on COMEX. That means performance is driven by futures prices, not by the profitability of mining companies or equity market factors. What makes CPER different from a simple front-month futures strategy is how it selects contracts. The fund uses a quantitative optimization process developed by SummerHaven Index Management to choose 2 or 3 copper futures contracts each month. The goal of this process is to reduce the negative impact of Contango, which is a common issue in commodity futures markets. Contango occurs when longer-dated futures contracts are priced higher than near-dated contracts. In that environment, rolling futures positions forward can create a drag on returns over time. CPER attempts to mitigate this by analyzing the shape of the copper futures curve and selecting contracts that may offer a more favorable roll yield, rather than automatically holding the nearest expiration. This approach can help improve efficiency compared to naive futures strategies, but it does not eliminate futures-related risks. CPER is still exposed to roll costs, tracking differences, and futures market volatility, especially during periods of sharp price swings or supply disruptions. Structurally, CPER is organized as a commodity pool, which carries important tax implications. Investors will receive a Schedule K-1 at tax time, and gains are taxed under a blended tax treatment regardless of how long the shares are held. That means a portion of gains may be taxed at higher ordinary income rates, even for long-term holders. For some investors, this makes CPER more suitable for tax-advantaged accounts, while others may prefer equity-based alternatives. From a portfolio standpoint, CPER offers pure copper price exposure. Unlike copper miner ETFs, performance is not driven by management decisions, operating costs, political risk, or broader equity market sentiment. If copper prices rise, CPER is designed to benefit. If copper prices fall, CPER will decline, sometimes sharply. However, this also means CPER can be highly volatile. Copper prices are sensitive to global economic growth, construction activity, Chinese demand, supply disruptions, and shifts in industrial policy. CPER is not a low-volatility asset and should be sized appropriately within a diversified portfolio. CPER is best viewed as a tactical or thematic allocation, not a core holding. Investors may use it to express a view on industrial metals, hedge inflation sensitivity, or gain exposure to global growth themes tied to electrification and infrastructure. It requires an understanding of futures markets, commodity cycles, and tax treatment. The bottom line is this: CPER provides one of the most direct ways to access copper prices through an ETF-like structure, using an optimized futures strategy to reduce, but not eliminate, contango effects. It's a powerful tool when used intentionally, but it comes with complexity, volatility, and tax considerations that investors need to understand upfront. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you prefer direct commodity exposure like CPER, or do you lean toward copper mining ETFs instead?